All right, today we're cracking open the case for Paychex, a company that's quietly become a massive backbone of American business. It's a silent giant for sure, but is it a great business? And maybe more importantly, is it a smart investment right now? Let's find out.
To really understand Paychex, you just need to know this one number, 1 in 11. That's it. That's how many private sector workers in the United States get their paycheck processed by this one company. It's an incredible, almost hidden scale that touches millions of lives every single payday.
And that incredible scale brings us right to our central question. Is this stable pillar of the U.S. economy just a relic from a bygone era, or is it actually a resilient, fortress-like investment for the future? Let's break it down.
At its core, Paychex provides payroll and HR solutions to almost 800,000 small and medium-sized businesses. And this is not a small operation. We're talking about over $5.5 billion in annual revenue, all of it built on the backs of entrepreneurs and Main Street America.
So, how did they build this empire? Well, it definitely didn't happen overnight. Let's look at the key decisions over the last 50 years that built the competitive fortress that Paychex stands on today.
You can really see the company's history in 3 key eras. First, you had the founder, Tom Golisano, who carved out a brilliant niche by focusing on the small businesses that the bigger players were just ignoring. Then, starting in 2010, CEO Martin Mucci led a really critical tech turnaround, pushing the company into the cloud and mobile. And now, the current CEO, John Gibson, is making a massive bet to expand upmarket.
That Mucci era was such a pivotal moment. See, after the Great Recession, the company was kind of stagnating. Mucci came in with this incredibly audacious goal. And this wasn't just about numbers. It was about re-energizing the entire organization and proving that they could be a tech-driven growth company again.
And that tech transformation is what created the modern money machine that Paychex is today. So let's pop the hood and analyze the engine that drives its truly elite profitability.
So nearly 3/4 of their revenue comes from what they call management solutions. That's the really high-margin recurring software and service fees for payroll and HR. The rest is supplemented by their PEO and insurance services, where they essentially act as a co-employer for their clients, and the interest they earn on all those client funds they hold temporarily.
And the result of that model? Well, look at this. Paychex operates at a stunning 40% operating margin, which is roughly double the industry average. That doesn't just happen. It reflects incredible efficiency and, more importantly, some serious pricing power.
This kind of profitability is protected by what investors call an economic moat. And for Paychex, that moat is built on one very powerful concept: high switching costs. I mean, think about it. Payroll is mission critical. Changing your provider is risky, it's disruptive, and it's a massive headache. Most clients, they just don't do it unless they absolutely have to.
But no fortress is invincible. Now we have to look at the other side of the coin, the risks facing Paychex and the multi-billion-dollar bet it's making to counter them.
There are really 3 primary threats. First, its focus on small businesses makes it vulnerable to economic downturns. Second, new tech-savvy competitors are always trying to chip away at its market. And third, the company just made a massive acquisition, which always comes with integration risk.
And that acquisition, that's the big bet. Paychex spent over $4 billion to buy Paycor, which is a massive move. The opportunity's clear. Push into the larger, more lucrative mid-market and acquire modern AI technology to future-proof their platform. But the risk is just as significant. They paid a really high price for a company whose growth was already slowing, and a complex integration like this could easily distract them from the core business that built their fortress in the first place.
So, with the fortress and the threats all laid out, let's bring it all together for the final verdict. Is Paychex a great business, and is it trading at a fair price today? First, you have to look at the people in charge, and on every key aspect: vision, execution, financial discipline. Management has a decades-long track record of earning a strong rating. This is a team that has proven it can navigate challenges and allocate capital wisely.
So what about the price? Well, based on analysis from Morningstar, the stock is currently trading at a meaningful discount to its estimated fair value. That suggests a potential margin of safety for investors. And on top of that, it pays a healthy dividend yield of around 4%, which offers a solid income stream while you wait.
So here's the final picture. A great business with a wide moat, excellent management, and a solid track record, now trading at what appears to be a fair, if not attractive price. The question for you to consider is this steady, cash-gushing compounder the right fit for your strategy?